on Wednesday morning. It was a $167 billion market cap company, a large size, but obviously not, not the Mag 7, not a, a trillion plus valuation, not anything close to that. And the expectations were pretty low. Analysts are expecting 23.1 billion in revenue. That would be a 5% year-over-year increase, and they're expecting flat adjusted earnings of $1.21 a share, and that's the adjusted number I have there, even though it just says EPS, not the reported number. It's what the number that analysts tend to report, and that's what Disney in this case was $1.21. And the pros going in, Disney Plus scalability. Disney Plus turned the profitable corner in the fiscal second quarter. So this is the fiscal second quarter that it reported a year earlier, and it's been sort of growing, not necessarily in a straight line, but definitely increasing. Once you have a profitable platform that had been losing billions a year for the previous years, it can be pretty sweet on the bottom line for a company. Earnings beats momentum. This is a company that had exceeded analyst expectations easily through fiscal 2024 and through fiscal 2020. Yes, through fiscal 2024 and in the first quarter of fiscal 2025 that ended in December. Relatively healthy tariff impact. Yes, there's consumer products. Yes, there's the impact on the economy, but it's an entertainment company. It's mostly, if you're in the U.S., you're enjoying the theme parks in the U.S., you're enjoying all this. So it's relatively sheltered above many other larger companies. This was before there was a threat for entertainment companies to have their things, tariffs on entertainment filmed outside of the country. Then cons, a weak second quarter movie slate with Snow White, definitely losing money, and there would be a charge coming at some point. And the Captain America installment farly underperformed what the previous installment did about 9-10 years earlier. A likely soft theme park results. Disney had mentioned this, and Comcast had said, the operator of Universal theme parks, which are perfect parallel for them because they also have, in the U.S., they have theme parks in Central Florida and in Southern California, matching Disney's, geographical setup. They had reported a 5% decrease in revenue and a 32% drop in adjusted EBITDA for their theme park business. And the gradual fate of the linear networks. This is the ABC. These are the cable properties, the Disney channels, where folks are, no one's paying so much for cable and they're suffering. So that was where we were. This is how things turned out. So we went from a $167 billion company, a stock that was down better than 12% over the past year, to today's company. And 1 week later, which is now, the market cap is up to $190.4 billion. Disney had a big gain, still down, still a little less than 3% down year over year. And it really odd with Disney, and I don't have the graphics here. The 3-year chart is also flat, and the 5-year chart is also flat. So, well, this is the 5-year flat. Sorry, the 1-year chart is flat. The 5-year chart is flat. So this is a company that's pretty much been a round trip to nowhere, despite the fact that there's clearly been a lot of volatility. If you look at all the ups and downs, definitely big highs up heading into 2021, then big downs, and still some ups and downs now. Clearly, if you look at the line, very end, it's really on an upswing again. Let's see if it does better than the last two upswings, which did not end so well. So revenue, $23.6 billion. This is a 7% year-over-year beat. Much better than the 5%. And again, when you're a large company like this is really, a positive development when a lot of the entertainment companies like Comcast posted negative growth. Earnings per share, $1.45 a share. That was the biggest surprise. It was a 20% increase. Analysts were expecting a decline. Some of the reasons behind the beat. It was a 7-fold increase in direct-to-consumer operating income. This is the Disney Plus, Hulu, ESPN Plus, not ESPN, ESPN Plus, their digital over-the-top streaming offering. All these things, they combined, while the revenue growth was roughly, okay. Subscriber growth hasn't been that impressive. On the bottom line, it's growing really well now that it's scaling and doing all the things right. Domestic theme parks, this is a big surprise. Their revenue was actually up 9%. Again, remember, Comcast Universal theme parks was down 5%. So it's 9% for the domestic theme parks. And their operating income was up 13%. Their second quarter movie slate was weak, as expected. But something that I sort of didn't really factor in, and I probably should have, was in the second quarter of the prior year, so in the months of January, February, March, Disney did not actually release anything of note theatrically to theaters. And unlike 2 years earlier where they had the big Avatar movie that bled into January, they really have too much content from the holidays doing well in January, February. So there was actually an increase there. So it held up better. And Disney did increase its earnings per share guidance. They now see $5.75 a share. So this is important because Disney had said back in December that their earnings per share will be growing in the high single digits, and then in the double digits in fiscal 2026, fiscal 2027. Well, that's going to grow double digits, up 16% is what 575 where it breaks out to. So clearly, definitely an earlier turnaround than expected, just like Disney Plus became profitable earlier than expected last year. Some of the cons are still there. Linear networks, it's still fading. People aren't jumping back to cable and the advertising that follows linear networks, the ratings on linear TV shows. People at the offices aren't really talking about what's happening on ABC, CBS, and NBC and Fox anymore. It's all about what's streaming on the streaming services. Negative operating income for sports and international parks. So internationally, revenue did decline for its theme parks, unlike its domestic, and its operating income also declined. Same thing for sports. Revenue did go up, but it's expensive, as you can imagine, to keep ESPN running with all the leagues and the teams demanding more and more every year for the carriage rights. And Disney Plus growth is stalling. The growth is basically up 1%, 2% domestically and internationally. Not really a lot to talk about, but overall, just a positive upbeat for the fifth beat in a row for the company on the bottom line. A strong report, the fact that everything is getting better. And then the final announcement that they had, which was basically made all the headlines. This, I don't think, was the reason why the stock was up, but it's definitely a big part of the story, is Disney is opening a new theme park. And it won't be Disney. It's a company, Miral. These are the developers that have a Yas Island in Abu Dhabi. Disney is not paying a penny into its construction. They're just going to sit back and collect royalties. So they're helping them. They're helping Miral design and develop the attractions. They're going to help train everybody and set everything up. And then from then on, they'll just be getting commissions, royalties, payments, and fees for everything that happens. Not just consumer product sales, but just the fact that their rides are being used and their likenesses and all these things. So it's a great deal. It's the 7th Disney resort. They have 2. They have one in Hong Kong, in Shanghai, in Tokyo. Outside of Tokyo, but they call it Tokyo Disneyland, but it's technically just outside of Tokyo. And of course, Paris and the 2 parks in the U.S. So resorts. It's actually the 13th theme park because there's 4 theme parks here, 2 in Paris, 2 in California. And Miral will own and operate, and 2 in Tokyo. Sorry, and Miral will own. Yeah, I already said that. So the pros, they have no capital risk. Again, they signed a deal. It's going to be incremental. Disney will help design and develop. Oh, I already said that. Oh, yeah, sorry. And more importantly, one thing they noted during the earnings call, Bob Iger had said that they don't expect this new park to cannibalize existing park locations. It's pretty far geographically, even from the Asian theme parks, to really make a big difference. But they also mentioned that, again, we know Disney's not cheap. And they also said, interesting Iger statistic, he said there's 500 million people within a 4-hour airplane flight out of Abu Dhabi that have the income means to afford a Euro Disney or an Abu Dhabi Disney vacation. So the Disneyland Resort in Abu Dhabi is going. The only con here is that it's not going to open until 2032. So even though there's no CapEx or anything that's really going to be, any material CapEx, they may have some, expenses just developing in the process. There won't be anything material coming in until after 2032. And again, it won't be the same as a park it owns. It's a park that it's just have a partnership where it's doing that.